Welcome to This Explainer. Today, we're going to completely demystify a really crucial accounting standard, IAS 8. We'll be exploring exactly how accountants handle changes in their financial reporting. And honestly, we're going to do it through a pretty fascinating lens. Time travel. How do you fix the past? And how do you adjust for the future? Well, let's find out. Right, let's just dive straight into this by asking a really fundamental question. What is an accountant actually supposed to do when a past decision needs to be updated? Does a company just, cross out the old number and quickly write in a new one? Do they have to pretend the old number never even existed? Honestly, the way a company answers this question tells you a whole lot about the true integrity of their financial statements. So here is how we are going to unpack this today. First, we'll separate principles from educated guesses. Then we'll look at the retrospective treatment for policies, the prospective treatment for estimates, how to handle prior period errors, and finally, we'll lock it all in with a master comparison guide. Let's start with part 1, principles versus educated guesses. To kick things off, we really have to separate a company's unwavering rules from its everyday educated guesses. If you mix these two up, the entire framework just totally falls apart. The source material actually brings up this brilliant reference to an iconic Bollywood movie quote from Amitabh Bachchan, Patishta Anushasan, which basically translates to prestige and discipline. And that perfectly captures the essence of an accounting policy. Just like deeply rooted human principles that define a person's character, accounting policies are a company's core principles. They're not meant to change on a whim. They are the strict discipline guiding the financial statements, meant to stay completely consistent year over year. And the core difference here is really all about intent. Policies are the consistent rules you live by, like choosing the FIFO method for your inventory or deciding to stick with a cost model over a revaluation model. You pick one and you stick to it. Estimates, on the other hand, well, those are merely predictions that naturally change as reality unfolds. Think about a teacher estimating that a lecture series will take 25 hours, but as the class actually progresses, it naturally extends out to 30. That's just the nature of an estimate. Things like the useful life of an asset, its residual value, or its fair value, they are just educated guesses that we fully expect to evolve. All right, moving on to Section 2, policies and the retrospective treatment. So what happens when a company actually needs to change one of those core, unwavering policies? How do we handle a massive shift in the very bedrock of our accounting? Because policies are the absolute foundation of your financials. Changing them is a huge deal. You can't just flip a switch. For today, IAS 8 actually requires you to become a time traveler. You must use retrospective accounting. Basically, this means applying the new rule backward in time, acting as if that new policy had always been the one you were using, right from the very beginning. So sitting here in the present day, if you change your policy, you literally have to look backward. You must completely restate your previous year's comparatives. And get this, if the impact of that policy change goes back even further, you actually have to adjust the opening balance sheet of the earliest period presented. You are fundamentally rewriting your own historical records just to ensure complete and total consistency. Now, you can probably imagine that investors might get a little nervous if you just start, rewriting history. Because you're changing a fundamental principle. You absolutely must thoroughly justify this to your stakeholders. You have to explain exactly why you changed it. Was it required by some new law? Or does it provide a vastly better presentation of the financials? You also have to specifically disclose the exact nature of the change, the precise dollar amounts involved, and crucially, how this whole time-traveling adjustment actually impacts your earnings per share. Now let's jump to Section 3, estimates and the prospective treatment. Let's shift our focus away from these strict rules for a second and look back at those educated guesses. Unlike policies, when an estimate changes, say you suddenly realize a piece of machinery is going to break down in 5 years instead of 10, you don't rewrite history. Instead, you use a prospective treatment. You basically accept that your past guess was, just a guess, and you look purely forward. From present day onward, into year 1 and year 2, you just apply the new reality. No time travel required whatsoever. So the crucial takeaway here is that because estimates are inherently expected to fluctuate, you don't need to mount some massive, complex defense of the change like you do with a policy. Think back to that lecture example from our source material. The teacher didn't need to formally justify to anyone why the 25-hour lecture took 30 hours, right? They just adjusted the schedule moving forward for the betterment of the class. It's the exact same for financial estimates. You just state the nature and the amount of what changed, apply it to your current and future periods, and simply move on. Which brings us to Section 4, Fixing Prior Period Errors. All right, now we arrive at the absolute wild card of IAS 8. We've covered changing rules and we've covered updating guesses. But what do you do when you simply made a mistake? Pay super close attention here because the definition is incredibly specific. An error isn't just a bad guess that turned out wrong. Nope. It is specifically an omission or a misstatement resulting from a failure to use or maybe the misuse of reliable information that was fully available to you at the time you published the financials. The source material provides a totally perfect kind of dramatic example of this. Imagine an employee absconded. They literally ran off with company funds in November. The information was definitely available to the company, but the accountant completely failed to record it by the time the statements were approved in May. That is a failure to use available information. That is a prior period error. And because this was a mistake regarding facts you already had in your possession, you do not get to just fix it quietly moving forward. You must once again step right back into the time machine. You have to retrospectively fix the past. You restate the previous year's comparatives to reflect what absolutely should have been recorded, and you adjust the opening balance sheet if the error is from even further back. Oh, and if it's completely impractical to do this retrospective restatement, well, you have to formally disclose exactly why it's impossible. Let's wrap it all up with Section 5, the master comparison. To make absolutely sure you walk away with total clarity today, let's contrast these three pillars side by side. The fundamental nature of the item directly dictates the treatment. An accounting policy is an unwavering principle. Therefore, changing it requires retrospective time travel to ensure historical consistency, along with some really high justification. An accounting estimate, well, that's naturally an educated guess. Therefore, its treatment is prospective. We just adjust our course looking forward, and much lower justification is needed. And finally, a prior period error is a mistake of missed available information. Much like a policy change, it demands retrospective treatment to thoroughly correct the historical record, requiring high justification and clear explanations if restatement is somehow impractical. Basically, the nature of the change completely dictates your direction in time. I want to leave you with this thought to ponder as you review financial statements going forward. We so often look at a balance sheet and think of it as this absolute, concrete math, right? But as IAS 8 shows us today, those numbers are actually a continuous, highly delicate negotiation. A negotiation between rigid past rules, ever-changing future estimates, and the constant human effort to correct our own errors. It really completely changes how you look at the bottom line, doesn't it? Thanks so much for joining me for this explainer, and keep questioning the numbers.